Welcome to Tesla Daily News podcast for February 15th, 2026. Today, we're tracking a mix of demand signals, energy growth, and regulatory changes that could move Tesla's fundamentals and investor expectations over the next few quarters. Story 1. A fresh read on U.S. demand shows Tesla may have started 2026 on a softer footing. Context. After a volatile 2025 for EV pricing and incentives, the big question for investors is whether Tesla can stabilize unit growth without sacrificing margin. Details. Registration-based estimates cited by Electrek suggest Tesla U.S. sales were about 40,100 vehicles in January, down from roughly 48,500 a year earlier, an estimated decline of about 17% year-over-year. Impact. Even though Tesla doesn't report monthly deliveries, the market often trades on these demand proxies. A sustained drop would pressure near-term revenue and could push analysts to trim first-quarter delivery expectations. The key investor lens here is margin. If Tesla responds with heavier incentives, you could see automotive gross margin compress again. Takeaway. Watch for confirmation in broader quarterly delivery trends and for any pricing or financing moves that signal Tesla is leaning into volume at the expense of profitability. Story 2. China is a double headline. Tesla's locally made volumes look down, and a new competitor is claiming the top spot. Context. China remains Tesla's most strategically important battleground. It's huge, fast-moving, and brutally competitive on price and features. Details. A French outlet, Le Blog Auto, reported Tesla sold 69,129 China-made EVs in January. Separately, Business AM reported Xiaomi's new YU7 SUV outsold the Tesla Model Y in January, calling it the best-selling vehicle in China for the month. Impact. If Xiaomi and other domestic brands keep taking share, Tesla's Shanghai utilization and pricing power become the focal points. Lower utilization hurts fixed cost absorption, and in a price-sensitive market that can quickly translate into weaker margins. On the other hand, if China is beginning to restrict the most aggressive price warfare, more on that in a moment, Tesla could benefit from a more rational competitive environment. Takeaway. For Tesla, China isn't just about units. It's about whether Tesla can protect profitability while defending share against well-funded local players. Story 3. Beijing is moving to curb the EV price war by banning sales below cost. Context. Investors have been worried that relentless discounting in China is structurally lowering EV margins for everyone, including Tesla. Details. Observador reported China has prohibited automakers from selling cars below cost after months of government pressure to cool the discount spiral. Impact. In theory, that's a potential positive for Tesla's margin outlook in China because it could limit the most extreme loss-leading behavior. But enforcement and definitions matter. Below cost can be hard to police when companies bundle subsidies, financing, and service packages. Also, it could accelerate consolidation. Smaller EV makers may not survive, which could reshape the competitive field. Takeaway. If the policy is enforced meaningfully, the biggest stock-moving implication is margin stabilization, not just Tesla's unit volume. Story 4. Tesla's energy business keeps stacking real-world scale. Another large mega-pack project is now live. Context. Tesla Energy has been the quiet, growth engine investors increasingly care about because storage can be less cyclical than car demand and can scale with grid investment. Details. IXBT reported CleanCo Queensland launched a Tesla Megapack storage system with 500 megawatt-hours of capacity at the site of the former Swanbank coal power plant in Ipswich, Australia. Impact. Utility-scale storage is a revenue and cash flow opportunity, and each large deployment reinforces Tesla's position as a bankable supplier. For valuation, more energy storage growth helps diversify Tesla away from pure auto multiples, especially if energy gross margins continue improving. Takeaway. Watch Tesla's quarterly energy storage deployments and any commentary on Megapack backlog, pricing, and production throughput. Story 5. Tesla just refreshed its home battery offering for Europe with a three-phase native inverter, Powerwall 3P. Context. In many European markets, three-phase electrical systems are common. Historically, that created installation complexity and extra hardware for some Powerwall setups. Details. Electrek reports Tesla announced Powerwall 3P first for Germany, with a native three-phase inverter built into a single unit, aimed at eliminating prior workarounds. Impact. This is a product-market fit improvement. The investor relevance is twofold. It can reduce install friction, which can lift adoption, and it can lower installed cost and support margin by simplifying the system. If Tesla can accelerate Powerwall penetration across Europe, it's another lever to grow the higher multiple energy segment. Takeaway. Energy is increasingly about execution details. Simpler installs and better compatibility can translate into faster growth. Story 6. Tesla's Supercharger network continues to monetize as other brands formally plug in. Context. For investors, supercharging isn't just a mode. It's also an emerging services revenue stream and a strategic asset in EV ecosystems. Details. Millennial reported Porsche announced an alliance with Tesla's charging network, with Porsche and Audi, both part of the Volkswagen Group, using Tesla's chargers to support their EV expansion. Impact. Each additional major OEM partnership strengthens Tesla's network effects and can generate incremental charging revenue, while also reinforcing Tesla's brand as the backbone infrastructure provider. The market will watch whether this becomes material enough to show up meaningfully in services and other revenue lines, and whether it drives higher utilization without degrading the Tesla owner experience. Takeaway. Track expansion of OEM access, pricing terms where disclosed, and any sign of supercharger utilization becoming a measurable earnings contributor. Story 7. Regulation risk is rising in China for some Tesla design features. Yoke steering wheels and hidden door handles are in the crosshairs. Context. Regulatory shifts can create unexpected costs, redesign cycles, and delivery timing issues, especially in high-volume markets. Details. Auto Express reported China is set to ban jet fighter-style yoke steering wheels under draft safety rules that could take effect in 2027. Separately, Turkish outlet Haber 7 reported China is also moving to prohibit hidden door handle designs, also citing safety concerns, with implementation stated for January 1, 2027. Impact. For Tesla, the financial impact depends on how widely these features are deployed in China-bound vehicles and how quickly Tesla can adapt. The yoke is mainly associated with Model S and Model X, which are lower volume, but rule changes can ripple into future designs and supplier choices. The bigger investor lesson is that China can change the rulebook quickly, so Tesla's localization and compliance agility matter. Takeaway. This is not a near-term revenue shock, but it is a reminder that product design and regulatory compliance are part of Tesla's competitive execution in China. Let's wrap it up. The big themes today are demand uncertainty in the U.S., intensifying competition and policy shifts in China, and steady momentum in Tesla Energy with both utility-scale mega packs and a more Europe-friendly Powerwall. For tomorrow, keep an eye on any fresh regional registration data, pricing or incentive updates, and more detail on Tesla's energy deployment pipeline. If you found this helpful, subscribe to Tesla Daily News Podcast and follow for your daily, investor-focused Tesla update.